The lion shows up and everyone starts running, you run with them. That does not work well in markets. In fact, you generally have to do the opposite.
In your lecture on the basics of finance and investing, you mentioned a book, Intelligent Investor by Benjamin Graham, as being formative in your life. What key lesson do you take away from that book that informs your own investing?
Sure. Actually, it was the first investment book I read. And as such, it was kind of the inspiration for my career and a lot of my life. Important book. Bear in mind, this is sort of after the Great Depression. People lost confidence in investing in markets. World War II. And then he writes this book. It's for like the average man. And basically he says that you have to understand the difference between price and value. Price is what you pay. Value is what you get. The stock market is here to serve you. And it's a bit like the neighbor that comes by every day and makes you an offer for your house. Makes you a stupid offer, you ignore it. Makes you a great offer, you can take it. And that's the stock market. And the key is to figure out what something's worth. And you have to kind of weigh it. The stock market in the short term is a voting machine. It represents speculative interests, supply and demand of people in the short term. But in the long term, the stock market's a weighing machine, much more accurate. It's going to tell you what something's worth. And so if you can divine what something's worth, then you can really take advantage of the market because it's really here to help you. And that's kind of the message of the book.
In that same way, there's a kind of difference between speculation and investing.
Yeah. Speculation is just a bit like trading crypto, short-term trading crypto. Maybe in the long run, there's intrinsic value. But many investors in a bubble going into a crash were really just pure speculators. They didn't know what things were worth. They just knew they were going up, right? That's speculation. And investing is, doing your homework, digging down, understanding a business, understanding the competitive dynamics of an industry, understanding what management's going to do, understanding what price you're going to pay. The value of anything, I would say, other than love, let's say, is the present value of the cash you can take out of it over its life. Now, some people think about love that way, but it's not the right way to think about love. Investing is about basically building a model of what this business is going to produce over its lifetime.
How do you get to the value of a thing on the stock market?
Sure.
Companies.
The value of a security is the present value of the cash you can take out of it over its life. So if you think about a bond, your bond pays a 5% coupon interest rate. You get that, let's say every year or twice a year, split in half. And it's very predictable. And if it's a U.S. government bond, you're going to get it. So that's a pretty easy thing to value. A stock is an interest in a business. It's like owning a piece of a company. And a business, a profitable one, is like a bond in that it generates these coupons or these earnings or cash flow, every year. The difference with a stock and a bond is that the bond, it's a contract. You know what you're going to get as long as they don't go bankrupt and default. With a stock, you have to make predictions about the business. How many widgets are going to sell this year? How many are going to sell next year? What are their costs going to be? How much of the money that they generate do they need to reinvest in the business to keep the business going? And that's more complicated. But what we do is we try to find businesses where, with a very high degree of confidence, we know what those cash flows are going to be for a very long time. And there are very few businesses that you can have a really high degree of certainty about. And as a result, many investments are speculations because it's really very difficult to predict. What I do for a living is find those rare companies that you can kind of predict what they're going to look like over a very long period of time.
What are the factors that indicate that a company is going to be something that's going to make a lot of money, it's going to have a lot of value, and it's going to be reliable over a long period of time?
Every consumer has a view on different brands and different companies. What we look for are sort of these non-disruptible businesses, a business where you can kind of close your eyes, stock market shuts for a decade, and that 10 years from now, it's going to be a more valuable, more profitable company. So we own a business called Universal Music Group. It's in the business of helping artists become global artists. That's sort of the recorded music business. And it's in the business of owning music publishing rights of songwriters. I think music is forever, right? Music is a many thousand-year-old part of the human experience. And I think it will be, thousands of years from now. And so that's a pretty good backdrop to invest in a company. And the company basically owns a third of the global recorded music, the most dominant sort of market share in the business. They're the best at taking an artist who's 18 years old, who's got a great voice, and helping that artist become a superstar. And that's a unique talent. And the result is the best artists in the world want to come work for them. But they also have this incredible library of, the Beatles, the Rolling Stone, U2, etc. And then if you think about what music has become, it used to be about records and CDs and 8-track tapes, and it was about a new format, and that's how they drive sales. And it's become a business about streaming. And streaming is a lot more predictable than selling records, right? You can sort of say, okay, how many people have smartphones? How many people are going to have smartphones next year? There's a kind of global penetration over time of smartphones. And you pay, call it $10, $11 a month for a subscription or last for a family plan. And you can kind of build a model of what the world looks like and predict the growth of the streaming business, predict what kind of market share Universal is going to have over time. You can't get to a precise view of value. You can get to an approximation. And the key is to buy at a price that represents a big discount to that approximation. And that gets back to Ben Graham. Ben Graham was about what he invented this concept of margin of safety, right? You want to buy a company at a price that if you're wrong about what you think it's worth, and it turns out to be worth 30% less, you paid a deep enough discount to your estimate that you're still okay. Investing, a big part of investing is not losing money. If you can avoid losing money and then have a few great hits, you can do very, very well over time. There are all kinds of risks in every business. This is one that I think has a very high degree of persistence. And I can't envision a world where beyond streaming, in a sense. Now, you may have a Neuralink chip in your head instead of a phone, but the music's going to come in a digitized kind of format. You're going to want to have an infinite library that you can walk around in your pocket or in your brain. It's not going to matter that much if the form factor, the device changes. It's not really that important whether it's Spotify or Apple or Amazon that are providers. I think the value is really going to reside in the content owners, and that's really the artists and the label. But that's sort of one example. Another example could be just, the restaurant industry. You look at businesses like a McDonald's, right? It's whatever, the company's like a 1950 vintage business, and here we are, it's, 75 years later. And you can kind of predict what it's going to look like over time. And the menu's going to adjust over time to consumer tastes. But I think the hamburger and fries is probably forever.
The Beatles, the Rolling Stones, the hamburger and fries are forever. What's the actual process you go through? The process of figuring out what the value of a company is. Like, how do you do the research?
So Chipotle, what attracted us initially, the stock price dropped by about 50%. Great company, great concept. Athletes love it. Consumers love it. Healthy, sustainable, fresh food made in front of your eyes. But ultimately, the company's lacking some of the systems and had a food safety issue. Consumers got sick, almost killed the brand. But the reality of the fast food, quick service industry is almost every fast food company has had a food safety issue over time. And the vast majority have survived. And we said, look, such a great concept, but their approach was far from ideal. We start with usually reading the SEC filings. Companies file a 10K or an annual report, and they file these quarterly reports called 10Qs. They have a proxy statement which describes kind of the governance, the board structure. Conference call transcripts are publicly available. It's kind of very helpful to go back 5 years and kind of learn the story. Here's how management describes their business. Here's what they say they're going to do. And you can follow along to see what they do. It's like a historical record of how competent and truthful they are. It's a very useful device. And then, of course, looking at competitors and thinking about what could dislodge this company. If it's an industry we don't know well, we know the restaurant industry really well. Music industry, we'll talk to people in the industry. We'll try to understand the difference between publishing and recorded music. We'll look at the competitors. We'll read books. I read a book about the music industry or a couple books about the industry. It's a bit like a big research project. And these so-called expert networks now. And you can get pretty much anyone on the phone, and they'll talk to you about an aspect of the industry that you don't understand and want to learn more about. Try to get a sense. Public filings of companies generally give you a lot of information, but not everything you want to know. And you can learn more by talking to experts about some of the industry dynamics, the personalities. You want to get a sense of management. I like watching podcasts. If a CEO were to do a podcast or a YouTube interview, you get a sense of the people. The kind of business we're looking for is kind of business everyone should be looking for, right? A great business. It's got a long-term trajectory of growth, even beyond the foreseeable distance, right? Those are the kind of businesses you want to own. You want businesses that generate a lot of cash. You want businesses you can easily understand. You want businesses with these sort of huge barriers to entry where it's difficult for others to compete. You want companies that don't have to constantly raise capital. And these are some of the great businesses of the world. But people have figured out that those are the great businesses. So the problem is those companies tend to have very high stock prices, and the value is generally built into the price you have to pay for the business. So we can't earn the kind of returns we want to earn for investors by paying a really high price. Price matters a lot. You can buy the best business in the world, and if you overpay, you're not going to earn particularly attractive returns. We get involved in cases where a great business has kind of made a big mistake, or you've a company that's kind of lost its way, but it's recoverable. We buy from shareholders who are disappointed, who've lost confidence, selling at a low price relative to what it's worth if fixed, and then we try to be helpful in fixing the company.
You said barriers to entry. How do you know if there's a type of moat protecting from competitors stepping up to the plate?
The most difficult analysis to do as an investor is kind of figuring out how wide is the moat, how much at risk is the business to disruption. And we're in, I would say, the greatest period of disruptability in history, right? Technology. A couple of 19-year-olds can, leave whatever university, or maybe they didn't even go in the first place. They can raise millions of dollars. They can get access to infinite bandwidth storage. They can contract with engineers in low-cost markets around the world. They can build a virtual company, and they can disrupt businesses that seem super established over time. And then on top of that, you have major companies with multi-trillion-dollar market caps working to find profits wherever they can. And so that's a dangerous world in a way to be an investor. You have to find businesses that it's hard to foresee a world in which they get disrupted. And the beauty of the restaurant business, and we've actually, our best track record is in restaurants. We've never lost money. We've only made a fortune, interestingly, investing in restaurants. A big part of it's a really simple business. And if you get Chipotle right and you're at 100 stores, it's not so hard to envision getting to 200 stores and then getting to 500 stores. And the key is maintaining the brand image, growing intelligently, having the right systems. Now, when you go from 100 stores to 3,500 stores, you have to know what you're doing. And there's a lot of complexity. If you think about your local restaurant, the family's working in the business, they're watching the cash register, and you can probably open another restaurant across town. But there are very few restaurant operators that own more than a few restaurants and operate them successfully. And the quick service business is about systems that a stranger who doesn't know the restaurant industry can come in and enter the business and build a successful franchise. Now, Chipotle is not a franchise company. They actually own all their own stores. But many of the most successful restaurant companies are franchise models, like a Burger King, a McDonald's, Tim Hortons, all these various brands, Popeyes. And there it's about systems. But the same systems apply whether you own all the stores and it's run by a big corporation or whether the owners of the restaurants are sort of franchisees, local entrepreneurs.
So if the restaurant has scaled to a certain number, that means they've figured out some kind of system that works.
Yes.
It's very difficult to develop that kind of system. So that's a moat.
A moat is you get to a certain scale and you do it successfully, and the brand is now understood by the consumer. And what's interesting about Chipotle is what they've achieved is difficult. They're not buying frozen hamburgers getting shipped in. They're buying fresh, sustainably sourced ingredients. They're preparing food in the store. That was a first. Quality of the product at Chipotle is incredible. It's the highest quality food you can get. You can get a serious dinner for under $20 and eat really healthily and very high quality ingredients. And that's just not available anywhere else. And it's very hard to replicate and to build those relationships with farmers around the country. It's a lot easier to make a deal with one of the massive food producers and buy your pork from them than to buy from a whole bunch of farmers around the country. That is a big moat for Chipotle. Very difficult to replicate.
You were talking about moats, and this kind of reminded me of Alphabet, parent company.
Sure. It's a big position for us.
It's interesting that you think that maybe Alphabet fits some of these characteristics. It's tricky to know with everything that's happening in AI. It's interesting that you think that there's a moat. What's your analysis of Alphabet? Why are you still positive about it?
It's a business we've admired as a firm for 15 years, but rarely got to a price that we felt we could own it because, again, the expectations were so high and price really matters. And really the sort of AI scare, I would call it. Microsoft comes out with ChatGPT. They do an amazing demonstration. People are like, this most incredible product. And Google, working on AI even earlier, obviously Microsoft was behind in AI. That was really their ChatGPT deal that gave them a market presence. And then Google does this fairly disastrous demonstration of Bard. And the world says, oh my God, Google's fallen behind in AI. AI is the future. Stock gets crushed. Google gets to a price around 15 times earnings, which for a business of this quality is an extremely, extremely low price. And our view on Google, one way to think about it, when a business becomes a verb, that's usually a pretty good sign about the moat around the business.